Chapter 1, Introduction to International Accounting. The definition of international accounting is an extremely broad topic. Basically, an international accountant is a person who has a global emphasis and knowledge of foreign countries. To explain better what international accounting covers, Chapter 1 had a case, which involved this multinational called Magnum. But in our video, we are creating a new company called ELG. Before entering into the case, some of the terms that involve international accounting include foreign currency, hedges, foreign direct investment, taxation, cross-listing, among others. All of these terms were perfectly related to all the activity ELG has. ELG Corporation is a multinational founded in the early 2000s, dedicated to mobile phones, headquartered in Florida. At their early years, ELG principal activity was to sell their products in the United States. How could ELG become international? On the next chapters, we will analyze different situations that ELG will confront as taking the decision of becoming international.
Chapter 2, Worldwide Accounting Diversity. It describes the impact that the culture has had on the development of national accounting systems. There are some factors that influence country financial reporting practices. First, legal system. There are two legal systems. First, the common law, for those countries who don't speak English. They tend to publish their financial statements because of the government rules, and it has to be with a prescribed format. Then the common law, begin in England, and only English language countries use it. It's interpreted by a court. The type of legal system in a country is important because it determines the primary source for accounting, which could be a government or a non-governmental organization. ELG uses the common law because it's headquartered in Florida, which it means its primary language is English. The third factor is the provider of financing. It explains where the money comes from. ELG financing comes from credits and shareholders, which means that our financial statements will be presented to the public.
Chapter 3, International Convergence of Financial Reporting. There's an important term that covers the title convergence. This refers to the goal of and work towards establishing a single set of accounting standards that will be used internationally. ELG plans to expand to another countries, becoming international. It has to find a system to reduce the differences between the different accounting systems. For example, the accounting system that ELG has is interpreted in US GAAP, and the countries we plan to expand will be presented in another accounting principles. So, to apply the convergence, we have to adapt our accounting systems and consolidate with the foreign financial statements.
Chapter 4, International Financial Reporting Standards. International financial reporting standards are a set of international accounting standards stating how particular types of transactions should be reported in financial statements. IFRS are issued by the International Accounting Standards Board, IASB. The purpose to create IFRS is that ELJ can use it instead of making several financial statements with the regulation of each country. IASB, through the IFRS, focuses in the recognition and measurement of current liabilities, provision and contingent liabilities, employee benefits, share-based payment, income taxes, revenue recognition, and financial instruments. Globalization is the reason why ELJ wants to become multinational, consequently use the IFRS. These are many differences between IFRS and US GAAPs that ELJ will handle. For example, inventory. IFRS uses lower of cost or net realizable value. US GAAPs use all IFO, less in, first out. Property, plant and equipment. IFRS use cost model or revaluation model. US GAAPs use cost model. Leases. US GAAPs provide tests to determine when a lease must be capitalized. IFRS do not provide tests.
Chapter 6 Comparative Accounting. The time has come. LG is expanding. Where? It's the unknown. What LG did was due diligence to investigate business in different countries prior to signing a contract. Some of the countries LG investigated include China, Mexico, and Japan. The purpose is to know their principal characteristics. China. Accounting and auditing in China have taken different paths in their development processes. Auditing firms audit mainly domestic companies and were under the state administration of audit, whereas accounting firms focus on companies using foreign investment and were sponsored by the Ministry of Finance. Some of the advantages that China has in the support of guanxi. But what is guanxi? Those influences someone has in order to get a favor and is the central idea of Chinese society. Mexico. Mexico has an established accounting and long history. The first professional body was established in 1917. The Mexican Institute of Public Accountants was one of the 9 founding members of the IASC. Mexican law requires all companies incorporated in Mexico to appoint one or more statutory auditors. Annual financial statements of listed companies must be audited by a Mexican CPA and be published in a nationally circulated medium. Mexico has a conceptual framework for financial reporting, which is basically included in 3 bulletins. A1, structure of the basic theory of financial accounting. A11, definition of basic concepts integrating financial statements. And B1, objective of financial statements. Japan. The economy is dominated by a few conglomerates known as keiretsu. Their main sources of finances or business are bank credit and cross-company ownership, rather than outside credit finance. Stock exchanges in Japan are government regulated rather than self-regulated and is administered by the Ministry of Finance. The Ministry of Finance plays a major role through its business accounting deliberations accounting. Independent auditors is not acceptable because they do not trust in external people. The profits of the company are measured on what they can distribute. The accounting profession has a relatively low social status in Japan. Independent auditors are not acceptable. The laws are a major influence to the economy.
Chapter 7 Foreign Currency Transactions. When 2 parties from different countries enter into a transaction, they must decide which of the 2 countries' currency enter into a transaction. The export sale is a transaction exposure that exists when the exporter allows the buyer to pay in a foreign currency and also allows the buyer to pay sometimes after the sale has been made. The import purchase is a transaction exposure and exists when the importer is required to pay in a foreign currency and is allowed to pay sometimes after the purchase has been made. The accounting issue is the deal with the change in the domestic currency value of the sales revenue and account receivable resulting in the domestic currency change in value. For example, if ELG wants to expand to China, it has to consider the value of the Chinese yuan. So, we have 1 US dollar equal to 6.20 Chinese yuan, 124 Japanese yen, and 50 Mexican pesos. It means that with 6.20 Chinese yuan, we have $1. Something to consider is the foreign exchange risk. How can this be applied? For example, ELG sells 10 mobiles at $1,000 each. This means China has to pay $62,000. But if the spot rate changes, in the case lowers the currency, we will have a loss. In the same case, 10 mobiles at $1,000 each in Japanese yen, we will have $1,240,000. And in Mexican pesos, we will have 150,000. To prevent the foreign exchange risk, we can use hedges to offset potential losses or gains that may be incurred by a companion investment.
Chapter 11. International Taxation. Taxes are one of the most significant costs incurred by business enterprises. Taxes can be an important factor in making decisions related to foreign operations. There are two types of taxes imposed on profits earned by companies with foreign operations: income taxes and withholding taxes. Most countries have international corporate income tax rate that varies between 20% and 35%. For example, China has a corporate tax rate of 25%, Japan has 38%, and Mexico has 30%, which means it is more convenient to expand to China because 1/4 of our profits will be designated to taxes and the rest will be to us. But we have to be careful with double taxation. For example, the income earned by a foreign branch of a U.S. company, in this case China, is subject to taxation both in China and in the U.S. A solution ELG can have a relief from double taxation through tax credits. These are the reduction in tax liability on income in one country for the taxes already paid on that income in another country. Countries with no or very low corporate taxation are known as tax havens, for example, the Bahamas. But U.S. regulations prohibit finding relief on tax havens. Withholding taxes are imposed on payments made to foreigners in the form of dividends, interest, and royalties. Most countries, including the U.S., tax income on a worldwide basis. The U.S. also taxes on the basis of source, residence, and citizenship. For example, if a foreigner spends more than 180 days in the U.S. is forced to pay taxes. Sales tax holidays are meant to stimulate the state's economy by encouraging consumers to pay more. Usually during big retail events like back to school or in preparation for warm or cold weather. Florida has no tax holiday this 2015. The state of Mississippi will have tax holiday from July 31st to August 1st on clothing or footwear, with sale price under $100 per item, tax-free.
Chapter 12. International Transfer Pricing. Transfer pricing is the setting of the price for goods and services sold between controlled legal entities within an enterprise. The three bases commonly used for establishing transfer prices, both for domestic and international transactions, are cost-based transfer prices, market-based transfer prices, and negotiation prices. For example, to negotiate with China in selling cell phones, the cost base transfer price is $80, including taxes. The market base is $90, and the final price to negotiate will be $100, which leaves us with a profit of $20. This means that our income exceeds our cost of production, and we negotiated at prices that thus do not have a big difference with the market price. Everyone wins. Chapter 14: Comparative International Auditing and Corporate Governance. An audit is the examination of the financial report of an organization, as presented in the annual report by someone independent of that organization. The financial report includes a balance sheet, an income statement, a statement of change in equity, a cash flow statement, and notes comprising a summary of significant accounting policies and other explanatory notes. Auditing is expected to improve the precision, quality, and reliability of information made available to the market and to enhance investor confidence in such information. Because LOG has transactions with China, LOG needs to be audited at least once a year to protect their shareholders and the general public from accounting errors and fraudulent practices in the enterprise. This is what the Sarbanes-Oxley Act of 2002 mentions. Corporate governance is a system of rules, practices, and processes by which a company is led and controlled. LOG has its managers. Their job is to balance the interests of the many stakeholders. The objective is to prevent these managers from making decisions that benefit themselves but that are detrimental to others.
The entire semester, we have been focusing on what international accounting is and what are the topics that it covers. Well, one thing we are pretty sure is that international accounting is an extremely broad topic, and probably during the entire semester we made fun of the fact that it was the first thing we memorized. But now that we know what international accounting is, we know that this definition became true.
A very broad topic because it's not just debit and credit, assets and liabilities like we are used to do in accounting. Once it becomes international, it covers a lot more topics like the ones mentioned. As international accountant, we must be aware of what is happening in the world because it is constantly changing and every country has its different accounting rules. So, we have to have a global insight, like they say. Think global, act global.
As an international accountant, it's our obligation to know to follow the rules to report in a correct form in the financial statements and presenting the public. We need to know, analyze, and make good decisions about the future of the corporate that we are in charge.
Thank you!